Every real estate investor starts with the same dream of building a real estate portfolio that will create wealth and financial freedom. You've got your first deal and you've purchased your second deal and you're in momentum. And now you've purchased your third deal and you've gone to your bank, and surprisingly the bank said, no, the deal has been declined, or you need a higher down payment. If you have experienced this, then you have just hit the real estate investor financing wall. It is the most common and frustrating obstacle to growing a residential real estate portfolio in Canada. And it is the point where I see investors get stuck or give up. But here's the Streetwise truth. Hitting this financing wall is completely avoidable if you have the right financing strategy from the get-go. The problem isn't your deal, it's just that you've outgrown the playbook of lending rules for that particular lender. My name is Dalia Barsoum. I'm the founder of Streetwise Mortgages, a multi-award-winning mortgage brokerage that specializes in rental property financing. Welcome to the Streetwise 10. Today, I'm going to give you the strategic playbook to break through the real estate investors' financing wall and to continue to scale your portfolio. To break through the wall, you first have to understand why it's there. Your first one or two mortgages were likely done with a big bank, which we call the A lenders, and they were great to get you started, but their business model is really not designed to support portfolio investors. They have two specific limitations that you need to be aware of that create the financing wall. The first one is their strict debt ratios. These are strict formulas to calculate your ability to qualify for a mortgage. And crucially, many of these lenders use only 50% of the rental income to qualify you for the mortgage and take into account 100% of the expenses. So as you add more properties, this math starts to work against you. And on paper, it makes it look like you cannot afford any additional mortgages. Second is the portfolio caps. The A lenders have unwritten internal rules. Some of them have policies that they would not lend to one client more than X number of dollars in a loan amount or more than 4 or 5 doors. So as your portfolio grows, they start to see you as, unfortunately, a growing risk, and they simply cut things off, and that is the wall. Now, this whole concept of the A lenders limitations is so important. It is the single biggest myth holding Canadian real estate investors back. In fact, I have done a deep dive on this particular topic through another video on this channel called The One Myth Holding Canadian Investors Back. In that video, I take a deep dive into all of the details relating to the bank's internal rules, and this will help you navigate them more effectively. So if you're feeling stuck, I highly recommend that you take a look at that video after this one, and I will put the link for you in the description. So how do we break through the financing wall? The Streetwise approach isn't just about abandoning the A lenders at the first sign of trouble. It is to strategically maximize every ounce of borrowing power across the entire lending landscape. It is actually a multi-stage process. Stage number one, which is the foundation, is about maximizing the loans we can get with the A lender space. While a single lender or a bank might cap you at 3 or 4 properties, the entire A lending space has tons and tons of lenders beyond the 5 banks that you are familiar with. The key to maximizing this space isn't just knowing the caps of the banks. It's about knowing their playbook. It's about knowing their internal rules and risk tolerances. And this is where working with an income property mortgage broker becomes one of your biggest assets. It's not just about the bank's tight guidelines, it's about how they actually run the numbers. Let me give you an example. Some A lenders, for example, will assume that if you have a line of credit, that you have used it all, although the balance may be 0. Imagine this. This can actually kill the file because that will really increase your debt load on paper. But not all lenders do that. Here's another example. It's called the seasoning rule. Let's say you've done a big renovation on a property and now it's worth $100,000 more and you're ready to pull your money out through a refinance. Some lenders will have a seasoning period. They would want you to wait for 6 to 12 months before they let you refinance, while other lenders don't. So by knowing each lender's cup of tea and sending the file to the lender that will not penalize you for having a line of credit and wouldn't have strict guidelines around seasoning, for example, is how you navigate this maze. This is how my team and I have helped thousands of real estate investors build up 20 and 30 residential property portfolios and finance them fully with the A-lenders space, securing them the best terms and rates for the long term. And only after we've maximized strategically on your borrowing power within the A-lender space, we would pivot to what we call the alternative lender space to continue to scale. Let's make that real. That A lender who only used 50% of your rental income, a B lender will often use 80 to 100% of the rental income. And they are also open to using income for self-employed clients, even though they may not report enough income on their tax returns. So working with these lenders next is the way to increase your borrowing power and to continue to grow. The rates are typically 1% higher than this group over here, but they will help you scale to the next level once we've maximized on what you can do with this first group. Stage 3 on this financing journey is commercial financing. Now, the most common use for this type of money is when you graduate to buying larger properties of 5 units or more, or mixed use properties or commercial, because the financing is based on the property's net operating income and not on you personally. But here is something that very few investors know. Commercial financing is actually a powerful tool for residential properties as well. Properties such as single-family homes up to 4plexes. But here's something a few investors know about. Commercial financing can also be a powerful tool for residential properties of 1 to 4 units. Let's say you're a successful real estate investor and you have completely tapped out with your capacity to borrow with the A lenders and the B lenders, and you may think that you have no options left or you have to take on a private mortgage. We can bring specific types of commercial lenders to the table that will actually help you finance a residential property, either to acquire it or take out equity from it at very reasonable cost. And this applies to anything from a single family home up to a 4plex. We've helped several high-level investors take their portfolios to the next level utilizing commercial money. And yes, we've actually used it on single-family homes as well. And the lenders looked at the property's ability to qualify for the mortgage rather than you personally qualifying for the mortgage. Stage 4 on the financing path is to utilize private money. This is the absolute last resort to go to once you have maxed out with all of these lenders. So if you are getting quoted a private mortgage to finance your deal and your property is in a good condition, most of the time you do not need a private mortgage. Most of the time it means that the broker you're working with has not exhausted all of these options for you, and there may be an opportunity within your portfolio to restructure certain things to bring you here or there. But that would be the absolute last resort. So the secret to growing a real estate portfolio and being able to qualify with the best lenders along the journey is to get your financing strategy right from the get-go and to work with a qualified income property financing mortgage broker to help you navigate this path and help you avoid these walls at each lender level. This is what we do here at Streetwise Mortgages. We help real estate investors, whether they're starting out or they're scaling up, develop a financing strategy. It is complimentary It will help you connect the dots, understand where your deals are gonna go, what your financing is gonna look like, how to maximize on your ability to get mortgages with the best groups of lenders, and give you clarity so you can move a lot faster and also avoid surprises. So if you're looking to scale, if you're looking to get clarity on your options, or if you're stuck somewhere here and you're looking for better alternatives, reach out to our team at Streetwise Mortgages and get your financing roadmap started. This was question number 4 in the Streetwise 10. If you enjoyed this video, please subscribe and like or share it with another real estate investor. Also, in the next episode, I am going to get into the nitty-gritty details of the next question of what is the best way to use your home equity to purchase a rental property. Tell me how many properties are currently in your rental portfolio and what was the biggest challenge you have faced when you try to scale. Share your story in the comments, and thank you for watching. And as always, stay streetwise.